The government just made a major change to how seniors are taxed, and most people over the age of 60 have absolutely no idea this affects them. Stick with me for the next few minutes because what I am about to share could literally save you or someone you love thousands of dollars every single year. And if you have a parent, grandparent, or relative who is retired or approaching retirement, you are going to want to share this video with them before they file their next return. Let us start with the big picture first. The United States has been going through one of the most significant shifts in tax policy in recent memory, and seniors are sitting right at the center of it. For decades, the tax system treated retirement income in ways that many financial experts considered deeply unfair. Social Security, pension payments, retirement account withdrawals, investment income, all of these have different rules, different thresholds, and different treatment under the law. And the problem is that most retirees are either paying too much because they do not understand the system, or they are making decisions that accidentally trigger bigger tax bills down the road. But here is where it gets really interesting. Recent policy discussions and proposals being debated right now in early 2026 are specifically targeting senior tax relief as a priority. And depending on where these proposals land, the impact on retirees could be enormous. So let me break down exactly what is being discussed, what already exists that you might be missing, and what smart seniors and their families should be doing right now to take advantage of every legal opportunity available. First, let us talk about what is already on the table for seniors under current law, because a lot of people do not even realize the benefits that already exist. One of the most important things to understand is the standard deduction for people over 65. If you are 65 or older, you are entitled to a higher standard deduction than younger taxpayers. Now here is something that trips up a lot of people. Social Security benefits. A lot of retirees assume that Social Security is either completely tax-free or completely taxable. The reality is somewhere in the middle, and the rules are based on what the IRS calls your combined income. Now, benefits can become taxable. This is one of the biggest surprises retirees face, and it is also one of the biggest opportunities for smart tax planning. Here is the tension that most people do not talk about. Every dollar you pull out of a traditional IRA or 401k in retirement is ordinary income. That means it counts toward your combined income calculation. So if you are not careful about when and how much you withdraw from your retirement accounts, you could accidentally push your Social Security benefits into taxable territory without even realizing it. This is why the order in which you spend your retirement savings genuinely matters, and why having a tax strategy in retirement is just as important as having had a savings strategy while you were working. So what are the new proposals that are generating all this buzz right now in 2026? There are serious conversations happening at the federal level about eliminating or significantly reducing the taxation of Social Security benefits entirely for middle-income seniors. This has been a policy dream for retirees for years, and it is now getting real legislative attention. The argument is straightforward. Seniors already paid into Social Security through payroll taxes their entire working lives. Taxing those benefits again in retirement feels like double taxation to many people, and there is growing political will to address that frustration. Additionally, there are proposals being discussed around expanding tax credits specifically for older Americans. The existing credit for the elderly or disabled is something that almost nobody talks about, and the reality is that its income thresholds are so low that very few people actually qualify for it in its current form. Reform advocates want to expand and modernize this credit so that it actually helps the middle-class retirees it was originally designed to support. There is also significant discussion around required minimum distributions, which are the mandatory withdrawals the IRS forces you to take from traditional retirement accounts starting at a certain age. The Secure 2.0 Act already pushed that starting age higher in recent years, giving people more time to let their retirement accounts grow tax-deferred. But new proposals would go even further, either raising the age again or giving seniors more flexibility in how they manage those withdrawals to reduce their overall tax burden. Now I want to give you something genuinely actionable here, because information without action is just noise. If you are a senior or you are helping a senior family member navigate this, here are 3 things you should be thinking about right now. Number 1 is Roth conversions. If you have money sitting in a traditional IRA and your income is lower in the early years of retirement before you start claiming Social Security or before required minimum distributions kick in, those years are often a golden window to convert some of that traditional IRA money into a Roth IRA. You pay the taxes now at what might be a lower rate, and then future withdrawals from the Roth are completely tax-free. This can be one of the most powerful tools available to reduce lifetime taxes in retirement, But it requires careful calculation because doing too much in a single year can push you into a higher bracket or trigger higher Medicare premiums. The good news is that 2026 brings real opportunities, starting with the senior bonus deduction. If you are 65 or older, you now qualify for an additional $6,000 deduction on top of the standard deduction. For a married couple where both spouses are 65 or older, that number stacks to $12,000 in bonus deductions. When you combine that with the standard deduction for married filers, a qualifying couple can shield up to $46,700 of income before paying a single dollar of federal income tax. That is a significant buffer, but it does come with phase-out rules. Once your income crosses certain thresholds, the benefit starts clawing back quietly. This is why knowing your exact income number each year matters so much. Now let us talk about Social Security taxation, because the senior bonus deduction actually changes the math here in a meaningful way. The formula that determines how much of your Social Security benefit gets taxed is based on your combined income, which includes adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. By using the senior bonus deduction strategically, many retirees can keep their combined income low enough to make Social Security benefits either partially or completely tax-free. The keyword there is strategically, because if your income pushes past certain thresholds, up to 85% of your Social Security benefit becomes taxable, and that is on top of everything else hitting your return. Now let us talk about Social Security taxation, because the senior bonus deduction actually changes the math here in a meaningful way. The formula that determines how much of your Social Security benefit gets taxed is based on your combined income, which includes adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. By using the senior bonus deduction strategically, many retirees can keep their combined income low enough to make Social Security benefits either partially or completely tax-free. The keyword there is strategically, because if your income pushes past certain thresholds, up to 85% of your Social Security benefit becomes taxable, and that is on top of everything else hitting your return. Now let me give you the 4-step retirement tax strategy for 2026. Step 1 is an income audit. Before anything else, you need a clear picture of every income source flowing into your return this year, including distributions, Social Security, investment income, and any business activity. You cannot plan what you cannot measure. Step 2 is Medicare planning. Map your current and projected income against the IRMAA thresholds and file SSA 44 immediately if a qualifying life event reduced your income. Step 3 is SALT optimization. If you are in a high-tax state, review whether itemizing beats the standard deduction under the new cap and explore entity-level tax strategies if you own a business. Step 4 is income shifting strategies. This is where tools like Roth conversions in lower income years, qualified charitable distributions from your IRA if you are 70 and a half or older, and donor-advised funds for bunching charitable giving can significantly reduce your lifetime tax burden. Here is the core truth behind everything we covered today. The difference between a stressful retirement and a financially confident one is rarely about investment performance. It is about proactive planning. The retirees who keep the most of their savings are not necessarily the ones who earned the most. They are the ones who understood the rules and made deliberate, informed decisions every single year.